Oil dropped over 8% in a single session today. Yet major tech stocks split in completely opposite directions. That single divergence created major market confusion across Wall Street today. Semiconductor giants like Micron and Nvidia dropped significantly today. Meanwhile, software giants like Microsoft surged over 2% today. Most beginner investors see green numbers and buy immediately without looking. That emotional impulse is how new trading accounts get wiped out fast. If I started investing in 2026, I would play today very differently. Here is what actually unfolded across stock exchanges earlier today. A temporary pause in Middle East military strikes sent crude crashing down. Brent crude dropped quickly toward $85 per barrel today. Falling oil prices instantly ease energy cost burdens for normal households. It also cools down immediate inflation pressures across the broader global economy. That short-term relief gave software companies room to climb higher today. The Dow Jones Industrial Average gained over 150 points today. Yet the tech-heavy Nasdaq stayed under heavy selling pressure overall today. 10-year Treasury yields pulled back toward 4.6% today. Financial news headlines claimed that market risk was officially over today. Smart investors know that news headlines rarely tell the entire story. Today was not a fundamental buying opportunity for every tech stock. Today was a classic relief bounce driven strictly by commodity price movements. The underlying business fundamentals for these companies did not change overnight. This week brings the biggest corporate earnings events of the whole quarter. Microsoft and Meta report their crucial quarterly earnings results this Wednesday. Apple and Amazon report their high-stakes quarterly earnings results this Thursday. The Federal Reserve also decides on interest rate policy this week. Big tech companies are spending over $700 billion on artificial intelligence. Wall Street wants to see real cash profit from those massive capital expenditures. If corporate profit guidance disappoints investors, today's stock gains will evaporate quickly. Chasing stock price spikes right before major earnings announcements carries immense risk. If I started investing today, I would ignore short-term market hype. Instead, I would target deeply undervalued stocks producing consistent cash flows. You want reliable business assets that generate profits regardless of market volatility. Let us break down how to identify those solid long-term stocks today. Our first stock strategy focuses on legacy semiconductor and hardware infrastructure leaders. Many new investors only look at hypergrowth tech stocks trading at high valuations. Those inflated valuation multiples get punished heavily when broad market sentiment shifts. Look at legacy semiconductor manufacturers with real physical factories and massive infrastructure. Intel represents a prime example of a heavily discounted semiconductor brand today. It currently trades at a substantial discount compared to competing chip makers. Wall Street criticized its heavy capital spending on domestic manufacturing foundries. Building modern microchip manufacturing plants requires massive capital investments up front. Yet federal subsidies from the CHIPS Act reduce those structural development costs significantly. Intel still holds over 60% total market share in personal computer processors. Its enterprise server chip business continues generating billions in predictable cash flows. When short-term traders panic over quarterly earnings, long-term investors accumulate solid shares. You are purchasing valuable physical infrastructure at a discount to replacement costs. That provides a strong financial safety buffer that overhyped growth stocks lack. Another classic value play sits directly inside the global automotive manufacturing sector. Ford Motor Company represents a deeply discounted business with reliable cash generation. Its popular truck line remains the highest-selling vehicle series in North America. The commercial vehicle division generates consistent, recurring revenue from corporate fleet customers. Wall Street penalized the stock previously due to early losses in electric vehicles. Ford responded by shifting capital allocation back toward its most profitable combustion vehicles. The stock trades at a remarkably low single-digit price-to-earnings multiple today. It pays a generous dividend yield that compensates patient long-term shareholders directly. When global oil prices decline, demand for larger commercial vehicles increases noticeably. That creates an immediate financial catalyst for corporate earnings expansion going forward. Holding cash flow heavy legacy market leaders builds real structural stability in your portfolio. If you're enjoying this daily market analysis, hit that subscribe button right now. Joining our growing investor community ensures you never miss critical daily trading updates. We cut through market noise to deliver clear, actionable insights every single day. Now let us analyze essential opportunities within healthcare and defensive, high-dividend stocks. Pfizer represents another clear example of an undervalued long-term core holding today. Investors heavily abandoned major pharmaceutical names after historic pandemic revenues subsided. Pfizer's share price dropped down toward historically low valuation multiples as a result. Yet management utilized past cash reserves to acquire lucrative new oncology development pipelines. Cancer treatments and essential prescription medicines experience consistent market demand through economic cycles. Patients require vital life-saving medications regardless of broader macroeconomic conditions or interest rates. Pfizer currently pays a solid dividend yield exceeding 5% per year. You collect consistent cash dividend payouts while waiting for new pipeline drugs to launch. Defensive value stocks act as vital shock absorbers for your total portfolio value. When high-priced growth stocks experience sharp corrections, defensive healthcare holdings remain steady. Another sector offering deep value right now is essential telecommunications infrastructure networks. Major wireless network operators currently trade at historically low earnings multiples across Wall Street. These companies control critical physical wireless towers that modern digital society requires to function. Capital expenditures for massive 5G network buildouts are finally tapering off now. That means future free cash flow generation will expand substantially over coming quarters. High free cash flow generation comfortably protects ongoing high-yield dividend payments to investors. Starting your investment portfolio in 2026 requires strict mechanical discipline above everything else. Never deploy all your available cash capital into the market on a single day. Upcoming volatility this week will offer significantly better price entry points for buyers. Utilize systematic dollar cost averaging to construct your core stock positions gradually over time. Divide your total investment capital into equal weekly or monthly purchasing tranches. If tech stocks fall after earnings reports, you automatically purchase more shares cheaper. If tech stocks rally higher, your initial existing share purchases gain immediate value. Keep roughly 20% of your total investment portfolio stored in liquid cash. Maintaining liquid cash reserves grants you flexibility when sudden market panic occurs. When emotional selling hits Wall Street, cash allows you to buy high-quality assets discounted. Successful long-term investing focuses entirely on managing risk before attempting to maximize gains. Evaluate real corporate balance sheets, quarterly cash flows, and sustainable profit margins always. Ignore temporary daily headlines and focus on long-term compound wealth building starting today. Look out for our next video posted daily right here on screen.